Peter Brown, with this virus, no one can predict where stocks are heading. Up the escalator, and down the lift, is the old stock market adage that remains all too relevant. The up bit had lasted for the past 9 years when stock markets had made huge strides, but in a very steady fashion. A slow climb up meant that markets rose most days, and the reasons were not hard to find. The recovery from the global banking crash in 2008 amid rock-bottom interest rates around the world has been very good for stock markets. The market had climbed as money poured into company stocks and as central banks printed money to try to boost economic growth. One consequence has been overinflated prices in some areas of the stock market, leaving them vulnerable to a correction. Nonetheless, market corrections since 2009 have been short-lived. The oil crisis in 2015 and hikes to U.S. interest rates in late 2018 were also scary signals for investors to sell up. Yet, the market recovered strongly on both occasions and went on to reach new all-time highs. And anyone who got out of shares or sold part of their holdings soon regretted it. But the enduring problem is that bear markets jump out to catch investors unawares. Investors lose their gains which have been built up over months, in a couple of days. We saw that in recent days when Wall Street shed 2,000 points in a few days. The last week or so has provided an example of the truth of the up the escalator and down the lift saying. Despite the huge sell-offs, stock markets remained at historically elevated levels last week, amid growing fears of the economic fallout of the coronavirus. Fund managers need strong arguments to take their clients out of stocks. A bit of bad news and a 10% correction, as happened last week, was not enough to do it. Selling when stock markets shed gains very quickly has proved to be a foolish strategy in the past. Indeed, clients would get very annoyed to be holding cash if soon after stock markets were to recover and go on to post new all-time high levels. That means that every time there is a correction, there is much advice urging investors to buy more stocks. The scenario in which a fund manager recommends liquidating a client's portfolio is when there is likely to be a fall of around 20% and when stock markets are likely to remain in a bear market territory for a number of years. For that analysis to come true, the prospect of a global recession would have to loom large. Or maybe, U.S. investors are also moving prices to take account of the policy shakeup should Bernie Sanders be elected as the next U.S. president. Whether the coronavirus is serious enough to cause a global recession will have to be weighed. A global slowdown is a certainty, but that will usher in even lower interest rates. Just look at the yield on the Irish government 10-year bond, at minus 20 basis points, a historic low. Germany. For more on this story, visit the news article link.